Hi, good evening, everybody. My name is Sean van den Berg. I head up client education at PH Online. Welcome to our session on exchange traded products. For those of you attending for the first time, this presentation is being recorded. I'll be sending it out to you guys so you can refresh and obviously review the stuff we're going through. Secondly, obviously, any questions coming through, just type them up in the little section provided in the toolbar, and then I'll answer the questions near the end. But let's get started. I'm excited about this little session because there's been a lot of interest in exchange traded products. So here's the agenda. What we're going to discuss is what are exchange traded funds mainly, why invest in them, what are the options, and obviously the pros and cons, the advantages and disadvantages. And then we're going to discuss some ETFs and ETNs in a bit more detail, but also the main focus tonight is how to choose an ETF or ETN, more specifically focusing on an investment strategy if you're an investor, building a portfolio using ETPs. And we'll just end of the presentation with upcoming webinars and traders forum meetings. Okay. So that's the agenda. Let's get going into the details. So why invest or why get involved in exchange traded products? First of all, obviously, it's an opportunity to invest in the market, whether you want to invest in the top 40 shares or gold or whatever. ETPs offer a way to invest without having to buy the individual shares, the indices, or even high-cost unit trust funds. Secondly, obviously, you save on fees, you save your money when it comes to trading fees. Some ETPs, by the way, or ETFs have management fees, but generally they are lower than unit trusts. You may not want to invest in the whole market. Maybe you like a particular share, especially, for example, their resource stocks have been running lately. You think there's a boom coming, so you buy into an ETF that tracks the resources index, for example. Those of you who also want to maybe take advantage of a weaker rand, just like investing in the local market, you can also buy ETFs that have exposure to foreign markets. We'll touch on that a bit later. Also, some of us might be looking for some income streams, be it through dividends or through interests. So you can buy into dividend ETFs and bond ETFs, obviously to get an income stream as such. And obviously, some of us also might want to get exposure to the commodities. You don't want to invest in things like an oil rig on your front lawn, but you want to have exposure to the oil price. So why don't you just buy into an ETN that has exposure to oil? What about coal? You want to invest in coal, buy a coal ETP. Okay, so those are just some of the reasons why someone would get involved in ETPs. Some valid reasons as such. So what are your investment options? How do you get involved with exchange traded products? There's two ways. First of all, obviously, on the PSG Online equity trading platform, they treat it exactly like a share. So it's especially for someone that's got an existing share portfolio, maybe wants to diversify, got too much exposure maybe to the resource stocks, maybe want to have more exposure to financials. So yeah, this is what you'd use it for. So it's ideally for someone that's got extra capital, and things like that. It's got an existing portfolio and maybe wants to diversify. The other option you have is the investment plan. This is for someone that wants to build up a capital amount. So there's two options. You can either go a lump sum. The minimum requirement there is 1,000 Rand. Alternatively, you can also go for a minimum monthly investment of 300 Rand per month. That's via debit order. And let's say you're building up enough capital one day so you can obviously expand your portfolio. So that's someone that's just starting out. So one of the major advantages, by the way, of the investment plan is the thing what we call a rand cost averaging. I'm going to highlight this for you in this little table. We've got two investors, investor A, investor B. Investor A buys 100 shares every month, okay? 100 shares every month. Whereas investor B invests a regular amount of 100 Rand in the same share every month. Now look what happens now. After, let me just get my little drawing tool here, my little spotlight. After 9 months, my number of shares bought, I would have had 900. This is for investor A. Okay, my amount invested is roughly about 900 Rand. And you can see what my average cents is, 1 Rand per share, 100 cents. So my average price per share is 100 cents. What I find interesting is my value of my portfolio is 900 Rand and my investment is 900 Rand. Okay, so it's all very well in there until now. But look what happens with investor B. He invests a regular amount of 100 Rand per month. Okay, what I find interesting is that his average price per share is 90 cents compared to 1 Rand. So his average price that he paid is much lower, first of all. Secondly, the value of the portfolio is much higher than investor A. Okay, how does that happen? Now this is where the magic comes in, what we call Rand cost averaging. There's two things that has to happen. First of all, it's a process of investing a regular amount in the market over time. So this is what we call the Satrix 40. What I wanted to show you is these vertical lines. That vertical line will be the beginning of each month. So imagine that's when your debit order goes off. So to highlight for you, when at the bottom of the cycle, you'll be buying more shares. For example, let's get an example here. There we go. Right at the bottom of the cycle, there we've timed it perfectly. Just happened to be at the end of the month. So we buy more shares at the bottom of the cycle. We also buy less shares at the top of the cycle. Okay, and that's what's highlighted here too. And that's how we get that situation where the cost is lower and the value is higher. Because over a period of time, remember it's over a period of time, that's where the magic kicks in. Okay, so those of you that are looking at a monthly debit order, maybe for your children's education, you're thinking more longer term, I have it in place for my children. Remember, it's minimum of 300 Rand. You obviously can have much more than that if you want to, but that's the magic, how it would happen. Okay, so let's get into the nitty-gritties. Let's talk about exchange-traded products. What are they, etc.? So first of all, the term exchange-traded products refers to an umbrella term. It refers to exchange-traded funds, ETFs, and exchange-traded notes, what we call ETNs. So the first exchange-traded product was the ETF, and that was launched on the JSE in 2000. So they've been around for about 13 years now. And the first ETN was only launched about 3 years ago, 2010. So they're very similar to unit trusts. They invest in a basket of holdings. So that makes them a cost-effective investment instrument as such. They're pooled investor funds, so they're open-ended. There's no fixed amount of units in the fund. So similar to unit trusts, they fall into the category what they call collective investment schemes. So what's important here, it gives you that peace of mind knowing that they are regulated. Okay, they have to stick to a prescribed investment mandate. Okay, so ETPs are listed on the stock exchange. They offer the same benefits as investing in a share. Okay, whereas the ETPs, so the ETF and ETNs, are passively managed. The shares within those respective funds are traded actively intraday. So that's where some of the differences come in now compared to unit trusts. They are valued at prevailing market prices. In other words, you can sell them whenever you want to intraday. Okay, whereas a unit trust, if they only obviously you'll get the price at the end of the day. Okay, so you can redeem them at any time. This is the ETP. ETFs, those that have dividends and interest, automatically reinvested. So you got this magic of compounding, this kind of drip kind of thing, dividends reinvestment plan, automatically gets reinvested into the fund. So you get obviously that growth also. But ETFs basically designed to track a wide range of instruments. So they actively manage growth portfolios. They can be fixed interest portfolios. And also what's growing in popularity is this, what they call mixed asset type portfolio. Okay, so we got any questions coming through? Remember, just type them up. Hope you guys can hear me loud and clear. If you can hear me loud and clear, just stick up your hands. Hope you guys can hear me. Mr. Americo Barato, if you can hear me, just stick up your hands to make sure that we can come through loud and clear on the system there. Hope you can hear me loud and clear. Okay, so welcome to those guys joining us still. Remember, this presentation is being recorded, and Hopefully everything will be fine this time with the technicals. So let's move forward. What are exchange traded notes? They share a very similar characteristic to exchange traded funds. The big difference comes now in they differ in the structure. Whereas both of them have a low market entry barriers, as such a low market barrier to entry. With ETPs, the exchange traded notes, they're very much more skewed towards commodity prices. So a lot of the commodities, all that kind of stuff, is mainly used with the ETPs. Okay. They are debt instruments. That's what exchange traded notes are. So they're non-interest paying debt obligations. So they're not equity instruments. Okay, that's where the big difference comes in. So they are not categorized as collective investment schemes, and therefore you must understand these things are not really regulated. So the big things there also is that this is what they call the ETN promise. It's all dependent on the financial strength of the issuer, which is mainly the banks and things like that. So as long as there's money available when you as an investor want to sell, that gives you that peace of mind. Okay. So it all refers back to the solvency and credit rating of the company. Okay. So ETN prices fluctuate with the prices of commodities and the holdings that they track. And obviously, when you redeem the price, when you sell out, it obviously depends on the underlying commodity price or the share price. Just understand when it comes to ETNs, you do not actually own the underlying commodities, be it platinum or gold or silver or gold and things like that. Remember, it's an obligation, it's a debt instrument. Secondly, what's very important with exchange traded notes, remember commodities don't pay any interest or dividends. You do not receive any dividends. Okay. So, yeah, any questions you guys have, just send them through and we'll take it from there just now. Okay. Let's move forward. Let's talk about the pros and cons quickly. There's a wide range of ETPs to choose from a wide range of providers. Remember, these things are just a cheap and safe way to get involved in the local market as well as international market. So it's a very simple way, especially for the do-it-yourself investor, to get involved in the market. Remember, these things are regulated by the JSE. You can buy them, sell them intraday like a share, so that ensures their liquidity. When it comes to ETPs, by the way, compared to shares, you don't pay a levy, what they call a securities transfer tax, which is 0.25% of the value when it comes to shares. These things, that's not applicable to ETPs, which is a bit of a cost saving. Now, there's two ways to get involved, either through a trading account or through investment plan. Just remember, with ETFs, okay, you receive dividends, obviously excluding the commodity dividends. That's the new gold and the new gold plats. They do not have dividends. But it's suitable for the DIY approach. You do not require a financial advisor to help you with this. Obviously, just some common sense. Index trackers do better when the market is trending upwards, whereas bottom-up, actively managed stock pickers do better when the market is moving sideways. So just a bit of some discretion there. On the disadvantages side, obviously, there are costs involved. To be aware of the relative costs. Some funds do have initial fees and annual fees and reinvestment costs, etc. But they're still much cheaper than unit trusts. Always remember that. Index. One of the biggest problems with the ETPs that are concentrated. Some, especially the top 40 stocks, the ones that track the top 40. Most of the top 40 stocks are very much skewed towards the top 5 shares. And obviously, you find a lot of funds being channeled into the top 40 stocks. That can lead to what they call market instability. Those top 5 shares falls, your whole index falls, and that obviously can be a risk. So be aware of that kind of stuff. Remember, ETNs do not offer capital protection. Remember, that comes back to that promise. Can you get out? That's where it comes to liquidity. Remember, they do not pay out any dividends. When you can have 1,000 million ETPs, you don't have any voting rights. What are you going to vote at? There's no such company called Satrix. Remember, there's an individual share as an exposure to a basket of shares. Yeah, so you don't have actually voting rights. So let's get into the actual providers and into the list of ETPs available. So there are roughly about over 63 ETPs available now, exchange traded products. You see that, oops, let me just go back, sorry. APSA Capital, by the way, when you get this presentation, you can click on the actual links. These will take you through to the link to give you more information about the individual companies. APSA Capital is the leader in the space of in the space of ETFs. They've got 15 on the market at the moment, followed by the Satrix, which has been, we were the first on the market, and then the Deutsche Bank's DVX trackers and things like that. On the ETN side, obviously that's still growing. They've only been around for about 3 years. Standard Bank's the biggest in that space, especially on the commodity side. The frustrating part about the ETP is that each provider gives the names, the products, different things. So it gets a bit confusing when it comes to those things. But let's go into the more nitty-gritties. Let's talk about the categories available. Okay, there are 40, so we talked about ETFs. There are 40 ETFs available, and they fall into different categories. The biggest category is what they call the top 40. This gives you the broad market access. There's 7 of them available. So obviously when you're looking at having exposure to them, you want to compare one to another, and obviously you want to go for the best one in the sense of first to market and obviously performance. When it comes to sector exposure, there's only 3 available. That's the Satrix ones. That's the industrial, the funny, and the resources. Property, there's 3 ETFs available on the property side. When it comes to money market and floating interest and bond interest, there's 8 available. And then the theme or style ETFs, there's also 8. So that's also a very popular category. The one I like a lot is what they call the multi-asset or balanced ETFs. There's only 2 at this point in time. And then I also like the foreign ETFs. Deutsche Bank is big in this space. They've got 5. And some of you might want to look at what they call the fundamental or RAFI ETFs. This is just using a valuation method. We're sort of looking at market capitalization. Just look at fundamentals, and then the constituents of the fund is based on that. And then at this point in time, we have the 2 ETFs. That's more on the new gold side. But they categorize as the ETF. Okay, so let's go into each one individually. Let's talk about the top 40 broad market access. So we're just looking at if anybody else has joined us. Okay, we have a few more people who have joined us a bit later. Welcome. I hope you guys can hear me loud and clear. If you guys can't hear me, we have a big problem. But anyway, guys, I hope that you guys are hearing me, because this presentation is being recorded and I will be seeing it out tomorrow. So we're talking about the different categories of funds available. We're talking about the top 40. This gives you the broad market access. These are the building blocks that gives you access to the market. And you can usually buy them either through a top 40 or what they call the Swix funds. Swix are more popular, and you'll see just now why. And we've got 2, I'm highlighting here, the new funds. Swix top 40 ETFs gives you a total return index. When I say total return, as dividends automatically reinvested on a quarterly basis to give you that total return. And then the Satrix Swix, this gives you that exposure to the top 40 stocks, excluding the shares held by foreign investors, and also reduces the mining and dual listed shares. So looking at basically local exposure. Okay, you see how these 2 funds have been performing. New funds up top here giving you 27%. This is over the last 12 months as such. And then we've got the Satrix Swix giving you 24%. So that's over the last 12 months, not too shabby as such. Yeah. Let's talk about the style of theme ETFs. Over the last 5 years, the Satrix DIVI has been the favorite amongst investors and has outperformed every other general equity fund, basically getting exposure to the top 30 companies, and these are chosen by the JSE based on the projected dividend paying out potential. So these guys have been the popular ones over the last 5 years. However, there is a new player on the block, a new honcho, and that's the New Funds Equity Momentum Fund. And this fund has returned 34.87% over the last 12 months, whereas Satrix DIVI only grew by 7%. And people say, now, why has that happened? It's got a lot to do with African Bank. Obviously, it's fallen from grace, and that's dragged the whole fund down as such. Okay, so why is this fund popular? The market at this point in time is in a momentum phase. You find that the markets, we're making new highs. We saw on Monday and Tuesday this week. Even today, our market is pushing higher and higher. So that's what we call the momentum phase. It's not cheap right now. You can see the market's trading at very high price earnings multiples. So it's driven mainly by the growth stocks. So there are 4 factors that contribute to this excess returns. First of all, obviously the market itself. It could be China, it could be gold, whatever. It's bullish sentiment, call it that. There are some value stocks that are running up higher, but as I mentioned just now, it's mainly the growth stocks. Companies that are growing, anticipating growing earnings more than the average. Those are the ones in favor. And then lastly, obviously, the small caps. There's a lot of swings towards the bigger and large cap stocks and moving out of the small caps. So you can see how the 2 funds have been performing. That was our Satrix DIVI up top here, 7.25. And you can see how this nice little trend here. This is on the new funds momentum. Okay, 34.7%, 34.87% over the last 12 months. And you can see it's breaking, making new highs, and new highs are going making new highs. Let's talk about multi or balanced ETFs. They are gaining popularity globally in the sense that they are trying to replicate the asset allocation of unit trusts. In the sense, when I say asset allocation, you diversify your assets along the different classes, be it property, cash, equity, and bonds, etc. But the 2 that we're going to discuss tonight are mainly focused on what they call stage of life. Okay, so they're using sophisticated proprietary research and also the investment expertise to select the funds to make up the ETPs. They are much cheaper than a normal multi-asset unit trust, which can charge between 2 and 3% higher per annum compared to these things. These ETFs only charge 0.5%. Okay, so there's 2 at this point in time. We only have 2. Both have done very well over the last 12 months. Talking about the new funds MAPS growth, it gave you 23%, and another one, the Protect, gave you 16%. Compared to the Satrix ETF, that gave you 26%. So remember, the Satrix ETF, that's including the resources and a lot of the rand hedge stocks. So there we go, MAPS. This is ideally a position for the aggressive investor, someone who wants to accumulate wealth, willing to take on a bit more risk. You see the asset allocation, 75% in the SWIX. So again, remember, we're excluding the mining and rand hedge stocks and things like that. 10% in government bonds, 10% inflation-linked bonds, and 5% in cash. So that's how it's all allocated as such, balanced. The portfolio, Protect portfolio, obviously this is for the investor looking for lower risk and maybe also closer to retirement. You can see that the asset allocation, 50% in bonds, 15% that's in the Govy, and 35% in the Orbi. These are just 2 different bonds as such. 40% in the SWIX and 10% in cash. So obviously you're looking more the interest with more stable, call it the returns as such, where the growth is more the market as such. Okay, see how they've been performing. Above us moving averages, so the trend is still up, still bullish. Okay, let's talk about foreign ETPs. There are quite a number of them available. They track the global indices, both in developed and emerging markets. So those of you who want to have exposure to offshore, especially with the rand weakening at the moment. So as I say, you want direct exposure. Look at Deutsche Bank's their funds. They're called DBX trackers. They're the primary issuer. Gives you access to Europe, as I say, developed markets, Europe, UK, US, Japan, and they have one fund that has the whole world market. And on the ETN side, Deutsche Bank has one that has exposure to the top 50 companies in Africa, in China, and in emerging markets. So it's a nice little mixture. So nice thing about this, by the way, is that they are traded in rands, so they can be considered as pure rand hedges, but also they are listed as in the inward listings. So obviously they have to apply to those rules and requirements. So they do not affect your foreign exchange allowance. You don't have to go get tax clearance and things like that, but you can have exposure offshore. So what I liked a lot is the Japan ETF, exposure to Japan. And if you see the next slide, how this has been performing, 54%. This is over the last 12 months. Remember, Japan for a long time, or they're still very much in the bear market, but the Reserve Bank, and especially the new Prime Minister, they've got a concerted plan to kickstart the economy, and they've made it a policy to weaken their currency, obviously to stimulate the exporters like Sony and Toyota and Honda, etc. So obviously the market has taken advantage of that. You can see this is in rand terms, not too shabby, 54% over the last 12 months. But you can anticipate this to go up with that monetary stimulus. They're trying to weaken the economy with on the currency side. It will benefit the exporters. Okay, let's look at some commodity ETPs. The top performing ETP over the last 12 months has been the Standard Bank Corn Linker. It gave you 42.7%. But saying that, not everybody is happy to get involved in one single commodity. We're talking about corn here, so it's not everybody's cup of tea. So obviously it can also be very volatile. And you also need to really understand the dynamics behind corn. So you need to understand a bit more about agriculture, the obviously supply and demand factors, the crop growing factors and harvesting, but also more importantly the weather factors. So what I like is rather have a basket of commodities. So you want to benefit from the asset class with less volatility, and that's why I like Standard Bank's commodity basket. I gave you 15%. Okay, it's not as high as 42%, the Standard Bank Corn Linker. But you look at New Gold, which is everybody's favorite. New Gold, I gave a negative of 2.42% over the last 12 months. So this is, if you want to have exposure to some commodities, or they have a basket. So what you're looking at here is a basket of 7 commodities, and they're weighted. The weighting is determined by the African production over the last 5 years. So it's mainly African production, gives you that diversified exposure, and also you're having that the growth story, the African commodity growth story. Okay, see how it's been trading. Yeah, sometimes there are days where it's slightly held and illiquid. You can see over the last 12 months that performance. Okay. So everybody's favorite is New Gold. It is a popular one. Just remember, it doesn't pay out any interest, doesn't pay out any dividends. It's purely the rand price of gold. That's what you're looking at. So if the rand is weak at the moment and the dollar weakens, the gold price weakens or goes up rather, you want to take advantage of that. So what New Gold does is they issue debentures, and each debenture is backed by physical gold. Okay, so which is equivalent to 100 ounces of gold bullion. That's held in a secure depository on behalf of investors. Obviously, they do charge a fee for that. There's an annual fee of 0.4% of the value of the gold held in custody. Obviously, they charge that to meet operating expenses. According to Profile Media, you can go to their website, fundsdata.00. New Gold was one of the best performing tracker funds over the past 2, 3, and 5 year periods. So I'm going to show you a slide here on the next graph. So the last few months hasn't been performing too well. It has been underperforming. It's a lot to do with the strength of the dollar. When the dollar strengthens, obviously gold price goes down. People rush into paper, rush into the dollar. However, when this dollar turns around, people feel insecure. Inflation goes up, especially the whole quantitative easing story. Inflation starting to go up. People moving to gold. Remember that safe haven appeal. This will turn around. So you want to have exposure to gold. This is the thing to look at. Okay. And then recently they've also just launched what they call new plat ETFs, and that's performing much better. So you can have exposure to the platinum price. This is a platinum rand price, and I prefer it compared to having exposure to the mines. You know the problems on the mines with labor, unrest, and production and things like that. Yeah, you're having the pure exposure to the platinum price in rand. Okay. So we spoke just now about the fundamental ETF. Satrix has a thing called the RAFI ETF. It weights the underlying constituents based on 4 fundamental factors, as opposed to just weighing the constituents by pure market capitalization, which is the size of the company. So what they roughly does now, that looks at dividends, looks at cash flow, looks at turnover or sales, and also looks at the book value. So then from there it ranks all the different stocks, and then from there it chooses the best ones based on capital performance, capital performance, and the investment income. Okay, so that's how it calculates it. So you can see how that's been performing, a bit of a sideways market for a while, but not too shabby over the last 12 months, 22.2%. Nice little growth there. Okay. Guys, I just hope you guys can hear me loud and clear. So we'll take it from there tomorrow. Okay, let's talk about property. PropTrax is obviously the most popular one. It's South Africa's first property second ETF. It replicates the price and yield performance of the top 20 listed property funds, obviously providing good income yields and capital appreciation. So it gives you, the investor, access to exposure to a high performance retail sector, obviously low interest levels, reasonable fees. It is ideal for the novice and professional investor. Yeah. On the other side of the coin, PropTrax 10. This is looking at the top 10 funds, and then each one has an equal weighting. So that's a big difference there. So it's looking at the top 10, and each one is equally weighted, and it has the highest distribution yield of all the ETFs. Okay, so remember, this pays out interest. Remember, it's not paying out dividends, so this is taxable. Remember, you're paying out rental income, and that's in the form of interest. Okay, well, distribution units. So these two funds have been performing. The top 20, 22% up, and the top 10 property stocks, 17%. It's a nice way to get exposure to property. Through one share, you have exposure to 10 or 20 stocks in the retail, in the estate, real estate market as such. Okay. So how do we choose a ETP? Okay. If I can give you a word of advice, keep it simple. Forget the fancy and complicated. All you have to do, start doing is just start watching how these things perform, and then pick those with the strong performance records and low fees. So conduct your due diligence, do your homework, and then finally analyze your research. Now go to those service providers, their websites, and go look at what they offer. Compare one ETP to another one on costs and things like that. But your goal is to put together a simple, fully diversified ETP portfolio. So what you want to look at is the level of assets. You want to go for one is quite large. You want to go for something that's very small. Obviously, you'll have a limited amount of investor interest if the company is very small. That translates to poor liquidity, and obviously a very wide bid-offer spread between the buyers and sellers. So that's going to be to your detriment. Something as illiquid. Second, you look at those volumes. That volume will translate into high liquidity, and obviously the higher the liquidity, the more popular it is, and obviously the tighter the spread. So it's just the opposite of what I said just now. But what's important, let's see what's happening here. Computer overload. How can it be overloaded? Stop sharing your cam if you're not doing so. No. Yeah. I don't know why it's coming through like that. But obviously, you want to buy into something that's not obscure. You want to have a broad, widely followed index. So be the first. Also, choose a fund that's got its first mover to market, not the imitators. So that's also just, if I can give you a tip, those are the ones you want to follow. Okay. Guys, let's move forward quickly. Get rid of my mouse here. Quickly, before we run out of time, you want to choose investment strategy that focuses on what they call a core and satellite investment strategy. A core strategy basically focuses on average return of the market. So you want to follow what they call the beta. So you want to put most of your funds into your core strategy. Basically something that follows the entire market, like the Satrix 40 and things like that. So the top 40 stocks. That's what you want to do. So different sectors, different geographic locations. That's what you're looking for. So over the last 12 months, a lot of investors have been preferring the Swix products. Remember, you're only looking at South African share registrars, excludes the dual listers and things like that, and that's your benchmark. The other side of the strategy is to what they call satellites. You'll see in the next graph, in the next slide, what we mean by satellites. This is where you want to allocate a smaller portion of your funds to these things, but you want to go for average market returns or above market returns, what they call alpha, so higher risk as such. Okay, there we go. So 75%, if I bring back my little cursor here, 75% of my portfolio is in the core portfolio in beta products, and we'll discuss that, obviously broke into a few different funds. If I'm allocating less funds, oops, let me just go back, I'm allocating less funds to 5 different satellite ETFs. So just a suggestion, this is one way to structure a portfolio. So here we go, here's your core beta portfolio, 75% allocated to these different funds. You might say, okay, this is I like my portfolio, 50% were allocated to the MAC growth. Remember, it's that stage of life kind of fund. I like the Satrix DIVI, because a lot of that was skewed towards the SA breweries and the British American Tobacco, Richmonds, the Rand hedge stocks. And then we still added something to the momentum funds. And also I like to have some exposure to the property market. I prefer the Prop 10. So obviously allocate 10% to each one of those top 10 stocks. Okay, so that's one way of just allocating beta funds. Whereas your satellites, you want to have some exposure to offshore. So yeah, I was looking at Japan, some went to Africa, obviously taking advantage of the growth story into Africa. Commodity exposure, I like it basket, and then the Satrix RAFI and the Satrix DIVI. Okay, those are just some suggestions to get started as such. Those of you that are looking at trading, instead of looking at investing and buy and hold strategy, you can also trade, especially the Satrix products, the Indie, the Fundi, the resource stocks. You can trade those as normal single stock futures and CFDs. You can also trade the new gold. I did this a few days ago. I went short on new gold. I was expecting a breakout of this channel. I was expecting a breakout over here. So you can go short of this product. Obviously, it went against me very quickly, so I closed out. You can see I had a very, very tight stop here. But the point I'm trying to make is that you can use these products also to trade, to trade on single stock futures and CFDs. So guys, I hope you've enjoyed this. We're coming to the end of the presentation. Just to highlight for you what's coming up in the next few webinars. In the month, we're going to discuss currency futures. This is part 2, going more into the fundamentals, what to look at when you're looking at trading currency futures. And then those of you that just started in the market, maybe look at attending the webinar on the 11th of September. That'll be the basics, introductory topics into the market. We discuss technical analysis at the end of September. Those of you, as I just mentioned now, trading single stock futures and CFDs, you want to learn more about that. We have a session in the beginning of October. Fundamental analysis at the end of October. Technicals again beginning of beginning of November. We discuss Japanese candlesticks. This has been the most popular webinar we've had this year so far. So a lot of people have all requested. Those are the ones that missed it, requested to have it again. So we're having it in the middle of November. And then we're going to discuss again investment strategies, growth and value strategies. That will be the end of November again. And then we now have our last session for the year. We discuss point and figure charts. Just remember, first come, first serve. These things are limited to the first 100 people that book. So please book early. And then talking about our Traders Forum meetings, this is where I actually go around the country and you can meet me face to face. I'm in Cape Town next week at the 21st of August. Thereafter, I'm back in Pretoria in September, in Durban in October. Our last one for Joburg is we're having it in November. And then my last one for the year, we're having back in Cape Town again. So anyway, guys, that is the webinar for tonight. Hope you guys enjoyed it. See if there's any questions that come through. No questions. So you might just call this early end to this presentation. But guys, thanks a lot for your participation. Just a quick summary of that. ETPs give you more choice, give you more control, and more protection of your investment portfolio. So obviously the main idea is that you want to add it onto your existing investment plans. But like all investments, the role of exchange traded products within your overall strategy is dependent on your financial goals and your preferences. Obviously, you need to do your research and obviously always use risk management. Remember, a PSG platform, you can either go the equity route or you can go the investment plan. Remember, lump sum, minimum of 1,000 Rand, or monthly debit order there, and that's also a minimum of 300 Rand there. If you're still unsure which ETP to choose, then ask your registered financial advisor to assist you. So from my side, good luck and happy trading. Thank you very much. There's my contact details, there's my email, and there's my direct phone number. And lastly, obviously, disclaimer. Remember, this was just for education purposes only. Don't rush out and go buy these things. And it wasn't a tip as such. It's for education purposes only. So, guys, from my side, thank you very much for your time. Thanks for your participation. And we'll talk to you guys again. Okay, thanks a lot for your time. Bye-bye.